Last time, we took a look at Aerocell Corp. Today, our focus shifts to Joby Aviation, Inc., traded under the ticker JOBY, a company that's, well, really at the forefront of developing all-electric vertical takeoff and landing, or eVTOL, aircraft. This technology, it aims to revolutionize urban air mobility.
Mm-hmm. It's certainly captured a lot of attention.
Absolutely. So our discussion today will explore the, let's say, intricate financial landscape of Joby. We'll be weighing its pioneering technological advancements and strategic market positioning against its current financial performance. The central question we're tackling is this. Considering Joby's pioneering achievements and strategic moves, can its substantial current financial losses and, frankly, high valuation be justified as an investment in future dominance? Or do they perhaps signal an unsustainable model with inherent long-term risks?
A crucial question indeed.
Right. So I'll be presenting the perspective that highlights Joby's future potential and its strategic progress.
And I'll be scrutinizing its current financial metrics and what they might imply for the company's long-term viability. Okay, let's dive in then. From my perspective, Joby Aviation is, well, it's far more than just a company. It's really an industry pioneer. It's actively laying the foundational infrastructure for an entirely new form of urban air mobility. And to truly understand its current financial state, I think we have to interpret it within the context of a very capital-intensive, high-innovation phase. The operational milestones, I think, are compelling evidence of its tangible, deliberate progress. Think of the first piloted eVTOL air taxi flight between two public airports back on August 14, 2025. That wasn't just a flight. It was a significant, verifiable step toward commercial service and, importantly, regulatory acceptance.
A notable milestone, yes.
And more recently, just on September 3rd, 2025, Joby successfully completed autonomous flight test for the U.S. military. This clearly demonstrates not just robust technology, but also, critical regulatory progress through some pretty high-stakes validation. Strategically, Joby is making aggressive, yet I think remarkably smart moves. The acquisition of Blade's passenger business for up to $125 million, completed by August 29, 2025, isn't just about adding assets. It significantly expands its future commercial network and market reach. They're effectively buying into an existing customer base.
Right, the Blade deal.
Exactly. And its partnership with ANA Holdings announced August 5th, 2025 for air taxi deployment in Japan, including demonstration flights at Expo 2025. Osaka, well, that showcases some impressive international ambition, signaling global intent. And crucially, all its current revenue right now is generated from flight services to the Department of Defense. This is a highly valuable early-stage market, both for technology validation and for a critical early revenue stream, which helps de-risk the technology development. Furthermore, with 48% insider ownership, those closest to the company have a substantial vested interest, aligning their fortunes directly with shareholders. And the company's stock performance, showing gains like 173.58% over the past year and 65.56% year to date, that clearly reflects significant market confidence in Joby's long-term transformative vision.
Okay, well, while I can appreciate the vision you've laid out and the technological aspirations of Joby Aviation are indeed grand, we really must scrutinize its financial fundamentals. And frankly, they present a far less optimistic picture. The company reported a staggering income loss of nearly $800 million. But what's even more alarming, to me at least, are the acutely negative margins across the board. A gross margin of almost negative 38,000%.
An operating margin over negative 650,000%. And a profit margin exceeding negative 813,000%. To put that into perspective, a negative gross margin of this magnitude means that for every single dollar of revenue they generate, their direct costs of production are literally hundreds of times greater. These aren't merely typical startup losses. They signal a business model that is, right now, profoundly unprofitable at its core. It suggests some deep structural issues that go far beyond what you might expect even from heavy R&D expenses. And the valuation is particularly concerning. With sales of just $0.10 million, that's $100,000.
Joby boasts a market capitalization of $11.52 billion. This leads to an astronomical price-to-sales, or PS, ratio of 115,215. That is high.
It means investors are currently paying over $115,000 for every single dollar of annual sales the company generates. It's a valuation completely disconnected from any current revenue generation, resting almost entirely on speculative future growth. Moreover, recent financial performance shows significant deterioration. Sales are down 90.97% year-over-year on a trailing 12-month basis and 46.43% quarter-over-quarter. Earnings per share, or EPS, dropped 127.78% quarter-over-quarter. Following the Q2 2025 earnings report, which saw a wider loss than expected and lagged revenue estimates, multiple analysts, including H.C. Wainwright and Concord Genuity, actually downgraded the stock, with some explicitly warning of overvaluation. The stock also exhibits a high beta of 2.51, which means it's over 2.5 times more volatile than the overall market, indicating extreme risk for investors.
And amidst the positive news you mentioned, there's also been consistent insider selling by several key officers and directors throughout July and August 2025, which, despite the high overall insider ownership, could suggest some are strategically capitalizing on market rallies rather than holding for the long haul.
Okay, look, it's tempting to apply traditional financial metrics, especially with numbers that stark. I get that. But I believe that framing kind of misses the core insight when we're discussing a company like Joby. Relying solely on metrics like price to sales, which are really designed for established businesses with predictable revenue streams, is, I think, fundamentally misplaced here. Joby isn't just iterating on an existing business model. It's actively creating the foundational infrastructure for urban air mobility. The core insight here, for me, is that investors aren't just betting on eVTOLs as a technology, they're betting on Joby's unique ability to navigate what people call the valley of death for hardware startups. Bridging that gap from intensive R&D to commercialization through strategic defense contracts and these crucial early infrastructure plays. This isn't just a vote of confidence. It's an implicit valuation of their regulatory foresight, their extensive patent portfolio with innovative eVTOL designs going back to 2014, and their first mover advantage. The market's enthusiasm, reflected in its impressive 173.58% year-over-year stock performance, is anticipating future market dominance rather than merely evaluating current, negligible revenue.
I understand the argument for viewing Joby as a market creator rather than an incumbent, and I absolutely acknowledge the innovative nature of eVTOLs. However, a price-to-sales ratio exceeding 115,000 for a company with negligible revenue, that goes beyond merely anticipating future growth. It points to a valuation that is highly speculative and potentially unsustainable, even for groundbreaking technologies. The critical insight maybe we're missing here is the credible bridge from today's staggering unprofitability to a scalable, profitable model. While innovation is lauded, an extreme PS ratio like this suggests that the market may have fundamentally misjudged the immense capital requirements and competitive hurdles still ahead. It implicitly demands a flawless execution path that's, let's be honest, rarely seen in disruptive industries. At the end of the day, the market eventually demands a clear and credible path to financial viability.
In fact, the median analyst target price of $13, which is actually slightly below the current close of $13.46, indicates that even market professionals are starting to see a limit to this valuation. This isn't just skepticism, it's a financial reality check, suggesting current pricing might be overextended relative to fundamentals and near-term prospects.
That's a valid observation regarding the market's eventual demand for viability, yet I think it overlooks a crucial aspect of Joby's strategic and deliberate path to commercialization. This is absolutely vital for a disruptive technology like this. Their strategy, I believe, is crystal clear. Secure defense contracts to fund and validate its technology. As you mentioned, its current revenue comes entirely from the Department of Defense. Now, this isn't just a placeholder. It provides a crucial early revenue stream and a really rigorous testing environment for their aircraft, effectively de-risking the technology with government funding. This high-bar proving ground accelerates their certification pathway.
the acquisition of Blade's passenger business, which we discussed, directly supports the development of its app-based aerial ride-sharing service and future commercial operations. It's specifically optimizing for urban routes and aiming for that 100-mile range. This is a targeted, forward-looking move to build out their future network and gain real-world operational experience. Furthermore, Joby's consistent quarterly lobbying efforts, spending between $30,000 and $60,000 on issues like aviation, airlines, airports, transportation, and defense, demonstrate a proactive and, I think, sophisticated approach to influencing the regulatory frameworks that are absolutely vital for its eventual commercial rollout. These aren't just expenses. They are strategic investments meticulously designed to pave the way for mass adoption and ultimately profitability.
I appreciate the point about strategic investments in defense contracts and lobbying, and I agree they serve a purpose. However, my concern lies with the sheer scale of the financial burn. While the reliance on DoD contracts provides a revenue base and some validation, it simply hasn't stemmed the significant financial bleeding, the immense negative operating and profit margins. They suggest that the core cost structure is simply not scalable towards profitability in its current form. It's one thing to invest heavily in future growth. It's quite another to demonstrate a clear and realistic path where those investments can actually lead to positive returns. While the Blade acquisition is certainly a strategic move to build out their network, integrating it and achieving commercial scale will require substantial additional capital. And this is in an environment where the company is burning through cash at an alarming rate, as clearly indicated by its Q2 loss. Analysts project negative EPS to continue next year, with EPS next year forecast at negative $0.79. This isn't just a distant horizon. It suggests that even with these strategic initiatives, profitability remains elusive. This raises serious questions about the sustainability of these growth initiatives without a much clearer and more robust financial roadmap that shows how they actually bridge this massive gap.
My interpretation diverges from yours when we factor in the significance of insider activity. The high overall insider ownership of 48%, well, that's a very strong indicator that those with the most intimate knowledge of Joby's operations and future plans are heavily invested in its success. They literally have skin in the game. Crucially, we cannot overlook the substantial buy by Toyota Motor Corp, who is a director of nearly 50 million shares for $250 million back in May 2025. This stands as a major vote of confidence from a global industrial powerhouse, a company that really understands capital-intensive manufacturing and disruptive technology. This kind of significant strategic insider activity, I think, underscores a profound belief in the long-term potential of the company. Any individual insider sales, while present, are often for liquidity, maybe tax planning or diversification, rather than reflecting a fundamental lack of faith in the company's future trajectory. It's a nuanced picture, sure, but the overall sentiment from those in the know, especially major strategic investors like Toyota, leans heavily positive.
That's a compelling argument, but I would frame it differently. While the overall insider ownership of 48% is indeed high, the consistent and I'd say widespread insider selling activities by multiple officers and directors throughout July and August 2025 at various price points simply cannot be overlooked. These sales occurred even as the stock experienced significant rallies and positive news, like the Blade acquisition and those operational milestones you mentioned. This pattern, I would argue, could be interpreted not as mere diversification or liquidity management, but perhaps as insiders strategically realizing gains on a stock whose valuation has far outpaced its underlying fundamentals. It presents a nuanced picture that complicates the narrative of unwavering insider confidence, especially given the company's recent Q2 earnings miss and those subsequent analyst downgrades. When multiple key individuals closest to the day-to-day operations are selling during rallies, it does raise a question about their personal assessment of the current valuation versus the long-term potential they publicly champion.
Well, I respectfully disagree with that assessment, particularly when you consider the sheer magnitude of Toyota's investment. That's a strategic corporate buy, not an individual's personal portfolio adjustment. Individual insider sales, especially in a company of this scale with high overall ownership,
typically don't negate the collective long-term commitment signaled by such a significant institutional investment. It really speaks to a different kind of conviction.
I suppose I just come at it from a different way. While Toyota's investment is undeniably significant, it's one large institutional buy set against a pattern of individual directors and officers systematically selling shares. These aren't just isolated incidents. The timing, particularly during periods of stock appreciation and positive news, it suggests a strategic decision to lock in profits at what they might perceive as high levels. This implies that perhaps even those insiders perceive the current valuation as incredibly rich, irrespective of the company's long-term vision. It's a point of contention that adds, I think, a necessary layer of caution to the otherwise bullish narrative.
As we conclude, the financial landscape of Joby Aviation Inc. presents a truly compelling case study. It's a balance, isn't it, between ambitious, future-forward innovation and current financial realities. From my perspective, Joby's pioneering role in the eVTOL market, its significant technological achievements like the piloted and autonomous flights, and its strategic moves to build out a future commercial network through acquisitions and partnerships, well, they all point to a necessary investment phase for a truly disruptive enterprise. The market's robust response to its operational milestones and partnerships, I think, signals a strong belief in its long-term potential and anticipation of its role in creating a whole new industry.
Conversely, my perspective has meticulously highlighted the stark financial metrics, the massive losses, the deeply negative margins, and a valuation that appears dramatically decoupled from current revenue generation. These simply cannot be ignored. These figures suggest inherent risks and a challenging, perhaps distant, path to sustainable profitability. They raise serious questions about whether the current market optimism is fully warranted by the underlying financial health. And the consistent insider selling, even amidst positive news and other large investments, further complicates that narrative of unquestioning confidence.
Ultimately, Joby Aviation's journey really epitomizes the complexities of investing in groundbreaking technologies. Its long-term success will hinge on its ability to navigate not just the technological hurdles of advanced aircraft design, but also the labyrinthine regulatory landscapes, and critically, translate its technological lead into a viable, scalable, and most importantly, profitable commercial enterprise.
Agreed.